Okay. All right. Well, good to be back over here. Let's start off with our series of indicators that we've been looking at. We've been going over the set of indicators, saying that all indicators are generally lagging and one must use the indicators in a proper way. Yes, sound and everything is good. We earlier had gone over the RSI, the Bollinger Bands, the MACD. The MACD session we will repeat again, since the quality was not very good. Let's have a look at the Slow Stochastic today. I'm facing a little bit of problem with my audio. I'm getting a lot of echo here, so it's a little inconvenient for me. But let's just go right ahead. Well, first and foremost, indicators. Right? One thing, let me just start with and repeat it again, which I have said earlier, is always use the indicators in a secondary role. No, I mean a primary way. All indicators are lagging. Generally, if you look at the calculation of any indicator, you'll see that it depends on price. So if you look at the calculation, you have the value N generally in an indicator. So price changes first, which causes the indicator to change directions, or it generally follows price. So if you have the indicator following price, why would you expect to give you an leading indication of an expected price movement? So indicators must be used in a correct way. The first thing is never use any indicator for your trading parameters. The simple fact is that if you choose to enter a trade based on, let's say, a stochastic line crossover, moving average crossover, MACD signal line crossover, you're going to be in trouble because it's lagging, and by the time you get into the trade has already gone about halfway through. So you are part of the crowd. As soon as you enter, price starts changing. And if you go long, price has already gone ahead, and the minute you enter, it starts going down. This is normally the thing which I have seen with a lot of traders. So entering a trade should always be based on price action. It could be simple levels of support, resistance, trend line breaks, Fibonacci levels, pivot levels, could be anything. But do not use any indicator to set the entry level or the stop level or even a target level of a particular trade. Right now, using indicators in a secondary role, one can use indicators in a primary role so long as you understand how the indicators work. For example, we had a look at the RSI earlier. The two examples, let me just go over. The RSI, we saw that if you use it in a regular oversold, overbought situation, you're not really getting the correct picture. So all the traders who are using the RSI as an oversold, overbought will probably get than half of your trades wrong. It's a simple fact. We saw that an RSI is best used to determine the breakout of price. When price is range bound and starts moving out, the RSI is the best indicator to tell you whether that particular breakout is a genuine breakout or it's a false breakout. Has the momentum really picked up on the correct direction? And we also looked at one particular way to plot trend lines on the RSI so that it gives you an earlier indication. Similarly, we had a look at the Bollinger Bands, saying that even the Bollinger Bands tend to squeeze together, you can expect a volatile move. Right, now let's have a look at the Slow Stochastic. Now the Slow Stochastic is an oscillator. So any indicator which is banded between a value of 0 to 100 is an oscillator. Like the stochastic, the RSI, the MACD, the CCI, the momentums, they are all oscillators. The simple fact is that oscillators do not work or are ineffective when price is in a trend. They work very effectively only when price is range bound. Let's have a look at this particular situation. Now, I would definitely classify this as a range bound price. Right? The price is between a value of a resistance and a support, just bouncing between the two. Now, this is the place where your stochastic or any oscillator would be quite effective. The stochastic becomes particularly effective because of its calculation. It gives you the oversold, overbought levels very clearly when price is in a range. So if you look at this and your stochastic, now price is moving in one particular tight range, and a stochastic goes oversold, this would be a good place to probably buy with an expected target, let's say, to the high of the zone. So in a way, it's quite good, but once again, like every indicator, it does become lagging. Now, one of the characteristics of the stochastic is when price is in a trend, we've seen that, or we know that price is, or the stochastic, any oscillator is not really effective. Now, let's just have a look at this particular downtrend. We have price moving in a pretty strong downtrend, as you can see over here. Now, if you use the stochastic like any oversold, overbought situation, and price moves down, your stochastic goes oversold. If this is a place where you would tend to buy at the crossover of a signal line, you would probably be in trouble because the indicator tends to remain in the oversold, overbought region for a longer time when price is in a trend. As you can see, I have highlighted it over here. So it tends to give you false signals. Now, one of the places where the stochastic, specifically, not the MACD, not the RSI also to a certain extent, but the stochastic can give you an indication of whether the trend is continuing or it's not. Right? Now, let's take the hard right edge of the chart. Supposing you are here. Now, at this particular situation, let me just put this back here. One would probably look at this strong pullback, right? This particular strong pullback. And one would think that price has probably changed trend to the upside. It's a pretty strong. Now, general thumb rules a lot of traders look at is in this existing downtrend, you have this pullback, which is a pretty small one. You have this pullback, which is a pretty regular pullback. And if you have a look at this pullback, it certainly is a very strong pullback, which most of the traders tend to take as an expected change of trend. So they would want to go long over here. First of all, they would probably enter at the crossover of this, go long somewhere here when price is crossed over and moves. And you tend to go long, you have some good profits coming in. What happens? Price keeps continuing towards the downside. So this is the disadvantage of any indicator, using it in a trend. But if you observe this particular pullback, and if you observe the value of the stochastic, it creates, let me just put it as the rubber band effect. Now, if you compare the peaks of the previous high of price and the peak of the previous stochastic, right? Can we see that this has been a pullback where price has made a lower high, but your stochastic has stretched and a higher high? Now, this particular kind of situation becomes very important because this is where your stochastic is telling you that there is still an expected move remaining in that existing trend. Now, this is a signal for us to re-enter a trend. And when you re-enter an existing trend, you're rejoining a trend, it it's a higher probability of a trade because you have, as they say, the wind in your sails, and the expected movement is pretty strong. The volatility is pretty strong. So if you come across a situation like this, and this is what I call as the rubber band effect, where for a regular pullback in price, which in an existing downtrend makes a lower high. Now, when I talk about a regular pullback, that means price has not broken the previous high. Simple fact is that it remains lower than the previous high, which is a classical indication of the continuing of a trend. Right? In an existing, your highs are going lower, your lows are going lower. Now, when you come across a situation where price makes a pullback, an regular pullback, which is a lower high, and your stochastic makes a higher high, your stochastic is stretching beyond the means. So it's like a rubber band. Once it stretches beyond the means, it will only snap back to the expected price, to the expected direction, sorry, and you will have price moving towards the downside. Now, without going into the detail, because this is a particular trading strategy which I follow, and we have refined it further to determine the correct entry, not based on the stochastics, but based on Fibonacci levels, expected price targets, expected stops. But the simple fact is that anytime you come across a situation where your stochastic has stretched, you can rest assured that there will definitely be an expected price movement. It may not go very far, but it will certainly break the previous low. So if you look at this one, right, we had an expected pullback and your stochastic had stretched. Price will definitely go below this low. It has to. So your expected price target is at least this low and beyond. Here we use a lot of Fibonacci ratios to tell us where it's expected to go. Let's take the second situation. Right, I have removed this and I have marked this. Now I have specifically marked this because these are the two trades which last month we had taken, and it's very clear in my mind. So I wanted to show this. Now if you look at this stochastic here, right, let's remove this. And if you look at the pullback of an ordinary stretch, let's say that this was in a longer term time frame, but we would stretch it over here. Right? If you look at this, price had made a pretty strong pullback, but your stochastic has stretched towards the overbought level. If it has stretched towards the overbought level, and I would compare it to a previous high, or what was the previous high? This was the previous high. And if I look at the stochastic, we can see that it's stretched beyond. So price did move down. What was the expected target beyond this low? It just maybe went a little beyond and started moving down. But on this decent trade, right? So this is what I call as the rubber band effect. Now the stochastics, I use it in two ways. I use it to identify a regular divergence, which we are not covering today, but we are covering only the rubber band effect. So you have to first identify where price is in a trend. Look at a trend. Look at the rubber band effect of price. If you have a rubber band effect, rest assured you have a high probability to trade. Now, this is also a rubber band effect. It can be definitely classified as a rubber band effect because you had price making a pullback. The low is higher than the previous low and your stochastic stretched down. But we did not have an existing trend. So maybe one could not have taken the trade. But the point remains is that once you have a pullback with a rubber band effect, you can see that the existing move, the subsequent move, is really very strong. Let's have a look on different time frames. Right? Let's look at this on another time frame. Can we not really look at this as a pretty decent uptrend? Do we have a rubber band effect over here? Let's just have a look. If this is a low where price, the stochastic has stretched, what is the previous low? This is a previous low. Can we consider this to be a rubber band effect? Well, quite possibly. So one day, I would probably go to a higher term time frame here. On a higher term time frame, it's really not. If I identify this, I would want this stochastic to stretch below this one. So it's not a rubber band. I would not really classify this as a rubber band effect. Just one practical point. You must have two consecutive cycles, my mistake, of a stochastic. For the simple reason, let's have a look at this. We are looking at a possible rubber band effect here. Right? Can you see this? What you have is you have a strong move down on the Euro JPY, but your stochastic has stretched way below the previous peak. Now, when I talk about two cycles, I mean these two cycles of the stochastic. If you have too many cycles of the stochastic in between price, it's usually not too effective. Then you should switch over to a higher term time frame. So in this case, if price has managed to find support somewhere, let's use simple levels of support resistance. Can we not classify this as a nice zone over here? Right? Now, price action, simple price action. This was a previous zone which was a resistance, which turned into support, There is a possibility that price could come all the way down over here. So we are not going to do anything to the Euro JPY, tend to remain short till it moves down to this level. The stochastics are already indicating a rubber band effect. But if price does find support here and the stochastics still have the rubber band, then you would expect price to bounce from here and give an existing uptrend. This is what I look at the stochastic at. And you can just look at any time frame. Let's have a look on the 15 minutes. Let's identify a trend. Now, this is a strong trend. Can we see a nice rubber band effect? There you go. Right over here. In fact, this was a beautiful rubber band effect. You have this stick cycle, and you have this one stretching beyond the means. Sorry, just give me a moment. There you go. So you have a regular pullback in a downtrend where the pullback does not take out the previous high. It's a lower high, and your stochastics stretch way above. And look at the move on the 15-minute. You would have taken a pretty nice move. Right, so this works on all time frames. The condition, of course, is that you must have an existing trend. It can even work at the beginning of a trend. So a rubber band effect at this stage, you really don't have an existing trend. Right? If you look at this rubber band, let's say we were over here. Price, in fact, was pretty much range bound. It's not really a trend, strong trend, but you did have a rubber band effect. Right? If you look at this was a pretty strong rubber band effect, which did work, but it works much better when price is in an existing trend and you come across that rubber band effect. So bottom line, once again, use the indicators in a proper way. Do not just use them as an oversold, overbought indicator, saying that when it goes overbought, you must sell, and when it goes oversold, you must buy, and enter on the crossover of the stochastic line. No, it's going to land you in real trouble. Use them practically. Understand what an indicator does. It's really worth your while to look at the calculation of an indicator, see how it's calculated, and understand how it affects or how it is affecting the price. All right, so I think this was about it. I won't take too much of your time. If you have any questions, I'm all over here. We'll continue next time. We'll repeat the MACD session which we had missed, or there was a sound or bad sound quality over there. Right? So I'll see you not next week. I'll see you sometime later this month for another series of our indicators. If you have any questions, please let me know. And as usual, this is my email. If you need to discuss some chart setups, please feel free to send me an email. And well, I'm on to the questions. The second way, Dhruv, is to look at a regular divergence, which is a reversal pattern. It's not. Now, this rubber band effect is a continuation pattern, but regular divergence is a reversal pattern. The stochastic is best used for that. Right. So any questions, please let me know. I'm in the room for some time. Otherwise, I'll see you folks during the next session. And till the time, well, have a good trading week. Have a great weekend. Best of luck with your trading. If you have any questions, feel free to send me a mail. I'm always here to answer it. Okay. So I'm in the room for some time. If you have any questions, please let me know.